Good evening and a warm welcome to everybody. I am Angelica Kinney, your host for the webinar today, and let's dive straight into it. Today's webinar is all about the art of asset allocation in mutual funds. And to understand this better, it is my pleasure to introduce Mr. Bhavesh Sharma, and strategy at ICICI Prudential Asset Management Company. He's the vital cog in the product development area, the team that keeps it updated and relevant, balancing the needs of the organization, investors, and other stakeholders. As a product specialist, Sir frequently travels in parts of the country, delivering seminars and webinars to investors and distributors of various products and features of the company. Sir surely brings expertise and practical insights to the table with a wealth of knowledge in our webinar today. Before moving ahead with the session, please note that if you have any questions, please send them in the comment box and we would take this up towards the end of the session. Sir, over to you.
Thanks a lot. And hi, good evening, everyone. So, I'm very happy to address every one of you today as the topic is very close to my heart. It is asset allocation. Although asset allocation is largely talked about from a 30,000 feet kind of a sense, very overview. I thought let's deep and understand how to use this art of asset allocation because ultimately it is something which affects each one of us in our day to day life. So, as an investor, I would always want to understand how much portion of my money should be invested in which asset class at what different point of time. What is the whole point of doing an asset allocation, or whether I should do it myself or should I give it to some expert to do it. So all these questions will be answered in today's webinar, and I will not be digressing much from the topic, talking about various things happening in the market. I'll be keeping it strictly towards asset allocation. We'll also avoid discussing any specific product in this particular category. For that, maybe we can have some other session. Today, let's just understand the concept. Once you understand the concept, I am sure you'll be open to understanding a lot of asset allocation products. Now, I personally like to start any particular session with a story, and in front of you, there are actually two parts of a story. You won't be able to understand just looking at the picture, but allow me to explain it. So, this story is of the Great Depression, which happened in 1929. This was a period where American markets they corrected by almost 80% in that particular year, which is one of the, or I think it is the biggest correction that we have ever seen. To give you an example, to give you a perspective, that 2008 in India, during the global financial crisis, from peak to bottom, markets corrected by approximately 60%. So you can understand what an 80% correction will do to the people, will do to the market. Anyone who invested 100 rupees at the peak, their value was left 20 rupees by the end of it. And after that, of course, there was again a recovery and everything that happened. But during that period, there was a very interesting story which I read and I thought to share with every one of you. Now, this story is of a gentleman who worked as an investment banker in Wall Street, and every day he passed by, he saw Shoe Shine Boy. So, Shoe Shine Boy is the boy during that period in 1929 in America. There were these 10-year-olds, 11-year-olds, 13-year-olds, young boys who used to work as a shoe shiner for part time to earn something. It was not a great period in history, so everyone had to earn, even young boys. So there was a young boy who was working as a shoe shine boy, and this gentleman, this investment banker, he went to that boy to get his shoes polished. So while shining the shoes, the young boy asked a very interesting question. He asked, "Which stock are you looking to buy? Are you invested in XYZ company or this company or that company?" And the investment banker, he was surprised with every conversation that the boy was having, every question that the boy was asking, because he is thinking, how does this boy know about this company, or how has he understood or learned so many things? Where is he getting his information or knowledge from? So he asked this peculiar question that, are you invested in this particular company? And the investment banker said, no, I am not. So the boy said, I think you should buy it. It is a very hot pick. Everyone is buying over here. And the investment banker, he asked this question back to the boy that, how do you know about all these stocks, and where do you get your information from? So the boy very honestly replied that there are so many people in the Wall Street who come every day to shine their shoes. They keep talking, and everyone can talk about is buying this particular company or buying this particular stock. And I just hear them and I repeat them. And the investment banker got his answer. As soon as he went back to his office, the first thing that he did is he put a short position to all those companies which the shoe shine boy was talking about. So the shoe shine boy told him to buy and to invest in those stocks, but he did the opposite. He shorted all these companies, whichever company information he got today. And in the next few months, his short position was actually correct, because he all these stocks started to correct massively. And when everyone was losing money, the markets were bleeding, there was a very big correction, this particular gentleman was making money in that kind of a market. This is an actual story which came into limelight 5 years down the line in 1934, when one of the journalists interviewed that investment banker to ask that, how did you make so much money in the last 5 years when almost everyone else were losing money? And this is the bit that he shared, that when the people who don't have any expertise or who don't have any knowledge, when they start to invest, and when they are very very confident about something without having any knowledge of it, that is when the markets are expensive, that is when one should get out of the market. So this learning he got from that shoe shine boy that day, he used it, he made a lot of money. Today, if we see how the story has developed today, or I think we should go a few months back. Few months back, again we saw a superb rally, bull rally in the market. People were putting in a lot of money in equity. If I suggested anyone that you should diversify or you should do an asset allocation, invest some money into gold, invest some money into silver, invest some money into REITs, or invest some money into debt, then most of them would laugh it off. They would ask, how much return will I get in debt? How much return can I get in REITs? How much return will I get in gold? Do you know how much I have made in equity in the last 1 year, in the last 2 years? And the answer would be in 20% plus returns, 30% plus returns in certain cases. So, looking at the past returns and looking at the past bull rally, many investors, they made up their mind that they are going to enjoy these returns each and every year going forward. And as a result, they refrained from doing any asset allocation. All everyone did was just follow the tips, follow the past returns, keep investing, and they kept on adding risk in the equity segment. Towards the right side of the photo, there is another story which is actually from a movie called Three Idiots. So in that there is a scene where our beloved character Chatur, who is learning from the librarian, he has to give a speech in Hindi, and the librarian is trying to explain what the word means, but he's saying, no, I don't need to understand the meaning. I will just by heart it. So leave everything else. Just give me the script, and I'll just by heart it. In today's parlance, what investors are doing is they're not trying to understand the investment, the logic behind it, the expertise behind it. They're just saying that no worries, ye acha hai, I'll buy it. So these are the two stories that I wanted to start with, and these stories help us to understand the need of asset allocation. And it is not that the need is only today. after 5 6 months of equity correction. This need was 6 months back also. This need was 1 year back also, 2 years back, 5 year back, 10, 15, 20. Every year, every day we need this. It's just that we understand the importance only when one asset class has a big correction. Only then we understand that our entire money should not have been invested in that one asset class. We should have diversified it at that time. So there are three different signals that we get of the market. One, if all the investors or if most of the investors are getting into very aggressive funds, they are investing aggressively into sector funds, thematic funds, which has a higher potential risk, then the markets are mostly in the late cycle, bull rally has happened, and investors they behave irrationally during this period because they are taking a very high risk at a very late cycle of equity market. If suppose balanced funds or hybrid funds are the top selling category where most of the investors are putting their money, then it suggests that markets are in the mid cycle. Mid cycle is when there has been a fair bit of rally and there is a fair bit of equity rally which is still left. This is the period where investors are not putting entire money into equity, but they are starting to allocate more and more amount using a maybe a hybrid fund. So this is a period where investors are mostly rational. And then there is another period where debt funds or fixed income is the top selling category where no one wants to get into equity, no one wants to buy equity. This is the period which we call as early cycle of equity. Usually, this is the period where people are afraid or scared of equity, mostly because recently there has been a correction. And over here also investors behave a little bit irrationally. Instead of putting more money into equity, they actually avoid equity altogether. This is something which we saw in the period during the COVID. There was a very big correction, and during that correction it spooked all of us out. As a result, many people refrained from adding money into equity. In fact, many people were getting out of it and putting their money into fixed income. So these are some of the signals that we get on a day basis, which helps us to understand where in the cycle are we. So there is one another interesting experiment. Again, to know the story, you won't get it just from the image. You will have to listen to me carefully. So most of my presentation is like that. You will not see a lot of data written. Either there will be graphs or there will be images. So I hope everyone is listening to me very, very keenly. Now, this story is called Marshmallow Experiment. Now, this is an experiment which was conducted where the kids were asked that I can either give you one marshmallow right now, or I can give you two marshmallow after 7 days, or I can give you 10 marshmallows after 1 month. Which one will you choose? One marshmallow right now, two marshmallows in a week, or 10 marshmallows in a month? Now, this question was asked to multiple kids to understand what their response will be. Majority of the kids answered that I would like to have one marshmallow right now. Very few said that I would like to have two marshmallows in 1 week, and hardly anyone said that I would like to have 10 marshmallows in after a month. So marshmallow, if you don't know what it is a sweet thing, similar to candy, you can say. So these are kids, and we are talking about candies. So this is not something which occurs only with kids. It occurs with each and every human being, even for adults. It is valid. Now, with this experiment, what they were trying to understand, there is a concept of instant gratification. This is the concept that they were trying to understand. Most of the people, if given an option, if given a choice, they would rather go for instant gratification than wait out. So, in again investing parlance, how does it connect? When anyone asks our expectations with equity returns or why do we want to invest, many people answer that I want to make money, I want to create wealth. Now, what history teaches us that to create wealth, to generate good returns, you need to wait for some time. Usually, if you wait for a longer period, then compounding can help you achieve bigger wealth creations. Knowing all that, learning history and everything, still people go for fast returns. People go for fast money. And this is another area where scamsters are very active. They promise you fast returns. If anyone has watched the movie Fir Hera Fairy, you know 25 दिन में पैसा डबल. So 25 दिन में पैसा डबल कैसे होता है? It happens only with a scamster involved. It's very difficult or it's very rare where in a proper method you double your money in 25 days. And also, this is not something that anyone can promise or tell you beforehand. So this is another learning. What we see with many investors is impatience. Everyone wants instant returns that you can get in a month, 3 months, 6 months, or in a year. No one wants to wait out for a good amount of time and generate wealth over a long period of time. This is another reason why many people do not believe in asset allocation, and rather they would take all the risk for maximum returns that they can achieve in the shortest period of time. As a result, many a times the risk is very high and they'll end up losing money. To give you again another example, so there was a report published that in FNO, that is futures and options trading, more than 90% investors, more than 90% traders, I would say, lose money. Now, this is a public information, this is a public report. In spite of knowing that more than 90% people do not make money in FNO, still you see so many people attempting or trying it and losing again and again and again. So, overall, this again tells us the need of asset allocation, and it highlights that asset allocation again is not something which is very easy that anyone can do, everyone can do. It needs a certain level of expertise. It needs a certain level of understanding economics. It needs a certain level of understanding how the markets are behaving, what your objectives are. So there are both the things involved, personal and related to market. Now, to give you an example, how the investment cycle works of an investor, this is typically what happens. You can see that graph. The black line, it denotes a fixed income return, so which looks very very steady. If you see the blue line, which is going up and down, this is the equity return on an average, where there is a lot of volatility, a lot of ups and downs. Many a times the returns is higher than what a fixed income is giving. Sometimes it goes down, and then again it can catch up in a long period of time. Now, the interesting part in this particular graph is the circles. Now, if you'll see, the circles are in different color. Red color is all those times when the equity returns are lower than fixed income returns. Coincidentally, this is the time when most of you need money. Coincidentally, this is the time when most of investors will say that I need to get out of equity market. When you can see the green color circles, this is usually the period where the returns are close to what fixed income is giving. So this is the period where most of the redemptions happen. Why? Because after correction, after the returns going below fixed income, when it again matches the fixed income returns, this is the period where people feel relieved and they don't want to take risk anymore, and then they get out of it. And when the equity markets are at its peak, when the returns are higher than fixed income in equity, as you can see in the graph, you can see the blue circles. This is a period where investors have surplus money to invest and they put the entire money in the equity space. After that, they witness the correction, and then they witness the recovery. What this graph is telling me, it is not predicting future returns or anything. What it is telling me is investor behavior. It is telling me how an investor behaves on a usual market period. In the peak of the market, investors will put in money. In the bottom of the market, they will withdraw money, citing that they need the money or anything like that. And when the market recovers and just, it is breaking even, or there is the returns is close to what a fixed income is offering, that is when people don't want to take risk anymore and they get out of it. Ultimately, an average equity investor is not making very high equity returns. They are instead making something similar to fixed income returns, and they are taking a lot more risk to do that. Now, why so? Because of our, again, investor behavior, and we will learn more about that in the slides to come. Very interesting slides to come. So, how does portfolio returns look like? We have been taught, I don't know by who, but we have been taught to look at the past returns. Now that does not make much sense when we look at equity returns, equity mutual fund returns, or any stock returns. There could be a stock where last 5 year return is 5,000%. Doesn't mean that next 5 year returns will also be 5,000%. There could be mutual fund where last 5 year CAGR return is 25%. Doesn't mean next 5 year CAGR return will also be 25%. But somehow, while making a decision, we just look at past returns and that's it. We don't look at anything else. What we are saying is, when you are investing, if you only look at returns and invest, then you might miss out on many things. There are two things that one can see. One is risk, and then the other one is return. What is in the control of a fund manager? Is returns in the control of a fund manager? Answer is no. Returns is not under anyone's control. It will be determined by the activities in the market. Towards the end of the day, we'll understand what happened, what is the new NAV, what is the new stock price. So it is not under anyone's control. But managing risk is possible. Risk management is under our control. How much risk to take is under our control. So rather than focusing on how much returns will I get, we should focus on how much risk we are ready to take. We'll be able to make better decisions. Because if I focus on return, then I might again miss out on many things, because returns I don't know. We cannot assess what will be the future returns. We can only assess how we will manage the risk in future, not the returns. Now in front of you, you can see there are different portfolios: portfolio A, B, C, and D. If I only look at the returns, I like the portfolio D most, because over there you can see returns is 25%. So I like portfolio D if I only look at returns. If I only look at risk, I am not looking at returns at all. I am only looking at risk. Then I like portfolio A the most, because it has the least risk. You can see standard deviation, it's only 12 in portfolio A. So if I'm looking at only risk and doing my investment, then I will invest in portfolio A. But if I look at both of them, what is the risk and how much returns we have generated, then we get the accurate picture. We get the most efficient portfolio, that is portfolio C, where we got 22% returns with 16 standard deviation. So risk reward ratio was 1.4, which is better than all the other portfolios. Now, what we are missing out while selecting is not looking at the risk, only looking at the returns. And there are certain people who only look at risk and end up investing either completely into fixed income or into a very, very conservative fund. So, to find the efficiency, we need to look at both risk and return. Then we will know which fund is the most efficient. So, how to do that? There is a ratio called as Sharpe's ratio, which is available in fact sheet. So you, whichever fund you like, just open that fund fact sheet and look at the Sharpe's ratio. Higher the Sharpe's ratio, better will be the risk return reward. Lower the Sharpe's ratio, lower will be the risk return reward. Again, can Sharpe's ratio predict the future performance? Answer is no. It only studies what has happened in the past and give you an information which you can use to understand if the fund has been efficient or not, if it has done well or not. So this is good for study purpose, but again, it will not give you the picture which fund will do the best in going forward. So another way of why asset allocation can help, rather than completely investing into one asset class, say equity. If there is an increase in equity, say 100%, you invested 100 rupees, it will go as high as 200 rupees. In an event where there is a correction, where there is a 50% correction, your 200 will again go back to 100. And to become 200 again, it will have to rise by 100%. So over a period of time where the equity rose by 100% two times, your return is from 100, it is only 200 rupees, because there was a 50% correction also. Now, if I use asset allocation over here, I can prevent the downfall. So while increasing, it might not increase as high as equity. Instead of 100%, it is only increasing 80%. But even while falling, it is falling lesser than equity. And falling lesser is also in a way equivalent to making returns. So as you can see in the example, second example, 100, 80% increase going to 180. From 180, it is correcting by 25%. It has gone down to 135. Again, when it is increasing by 80%, the new value is 243. So it has crossed the older value of 180. That is how you are making progress little by little over a period of time. So in a short period, most of the people will feel 100 to 200, the 100% rise in equity is better. But over a period of time, you will realize that if the fund falls less, even that is a boon, even that helps in generating returns in the portfolio. Maybe in long term, this second example can beat the first one by taking even lesser risk than the first one. So there are two ways you get benefited when you do asset allocation. The first benefit is you can manage the cyclicality in the asset classes. Now, what do I mean by cyclicality of asset class? I'll show in the next slide, where not every year is the best year for same asset class. For example, 2023 was a superb year for equity. Even 2024 first half was very good for equity, but second half there was correction which started. And now 2025, like the way it is going for the first few months, equity is not looking that attractive. So some other asset classes may benefit instead of equity. The second reason why asset allocation can be useful for you is managing investor behavior, because our behavior works on how the past returns or how the portfolio returns are looking like. And if I put the entire money in one asset class, and if that asset class does not do well, then I might have end up losing money instead of making money. So to manage my behavior as an investor, asset allocation is super important. Now, which are the different ways of managing assets in mutual fund space, in investing space? It's typically debt, equity, gold, and some other commodities like silver, where we can easily invest. There is also REITs, but again, there are not many REITs which are listed in India. These are real estate investment trusts. So, an investor dilemma comes from the fact they want to understand which asset class is the best asset class to invest today. Should I invest into large cap, mid cap, small cap? When should I enter the equity market? When should I exit it? What would be the cost? What would be the expense ratio? What would be the taxation impact if I exit now? So all these things, there are so many queries which they have to answer. And when I am talking about the cyclicality of asset class, this is a classic example of it. As you can see the period over here, 2016 equity did not do well, only 3% returns, whereas 2017 was a superb year. Again, 2018 equity did not do that great. 2019 was much better. 2020, 21 was much better. 2022 again it did not do well. 2023 again it was much better. So what is happening? Not every year is the best year for equity. Similarly, not every year is the best year for fixed income or for gold. It keeps on changing. And to manage that, if I put money into all the asset classes or different asset classes, then I will be in a much better position rather than investing only in one place. If anyone tells you that won't it be better if I put everything in equity, say in 2019, and I stayed invested till 2021, so for next 2 3 years I made super money, even better than say fixed income or gold. The only problem with that is the data that we are seeing in hindsight. This is not a future data. In hindsight, we can see that equity made better returns or gold made better returns. But today, when you are investing, you don't know next year will belong to which asset class, or the year after that, or the year after that. So the option that we have is we can either do asset allocation, or we can invest in equity, but for a very, very long period. So over a period of 10 years, 15 years, or 20 years, my average return looks good in spite of the ups and downs. So these are the two ways where it can work. Only problem is when while investing in long term, there are so many data points which says you have made super money, super money. However, the people investing in long term, there are not enough. Most of us, like I showed the marshmallow experiment, everyone wants instant gratification. So if 1 or 2 year equity does not do well, many people will be tempted to get out of it, out of fear, or out of FOMO, that they are losing out on opportunity by investing over here. So now this asset allocation is not only about different asset classes, but it can work in different market caps also. For example, not every year is the best year for small cap or mid cap. Not every year is the best year for large caps. It keeps on changing year on year. The data in front of you says that there are certain years where large cap is the best performer, certain years where mid cap or small cap is the best performer. And of course, again, we cannot choose next year will belong to which particular market cap. So instead of doing that, we can diversify. We can do allocation in different areas. The same thing can happen in sectors also. Now there are some sectoral schemes which got popular. So for example, in 2021, a lot of people were putting in money in tech, because 2020 and 2021, before October, tech had done well. Returns were very high for last 1 year, 3 year, 5 year. So many people were putting money in tech in 2021, which was actually, as per valuation, it was extremely overvalued. And as a result, what happened in 2022, tech did not do well. As you can see over here, 2022, tech is one of the worst performers. So this is what happens with many investors. They look at the past returns, invest when something is very overvalued or at expensive valuations at the peak, end up losing money in the next 1 2 years, end up losing patience and getting out of this particular market. So overall, their investment journey doesn't look very, very attractive or happy. The experience does not look great. As a result, you invested in equity, you took that chance, you took that risk, but the end result was not great. Ultimately, you forgo everything. You say that leave it, I'll only invest in, say, fixed income. So we don't want you to lose out on that. We want you to experience the returns, the higher return potential of equity, gold, everything, but in the safest way possible, which is by doing asset allocation, which is by following an expert advice and not doing everything DIY. Now, why long term investing, although it works, but only if you are investing for a longer period of time. Now, this is a very good data, which is of 2022-23 till 22-23, which showed us that on an average, when does equity units, mutual fund units gets redeemed? So if you look at the data, more than 56% of the units gets redeemed in the first year, and as per 22-23, it is approximately 50%. And if I want to see that how many units actually stay for longer than 5 years, then it is hardly 2 to 3%. Most of the units gets redeemed before 5 years. This is a very, very good data to understand that there are so many less investors who are actually investing for more than 5 years. Many of us, we enter thinking that we'll be investing for 10, 15, 20, 30 years till our retirement. But looking at the ups and downs, many people find it difficult to stay past 1 year, 2 year, or 3 years. and more than 5 year, hardly 2 to 3% of mutual fund units have spent more than 5 years in the market. Alarming data, and this tells us the need of asset allocation, why we should not go behind the greed of generating more returns, but rather look at the overall investor experience during that entire period. Still, if you want more data to understand that why investors do not behave rationally, you can see that whenever the market valuations were looking high, instead of getting out of equity into, say, fixed income or gold, there were more and more money which was being coming into equity, as you can see from the flows here in crores in terms of high valuation. When the market valuations were low and when there was the perfect time to actually add more money, so that you can buy equity at a very cheaper price, you saw that most of the investors were getting out of the market at that time. And this data again helps us to understand that why asset allocation is needed so much. There is a very interesting study which was done. This is the, I can say, one of the most important slide in today's presentation, which I would urge everyone to look at it in a very, very close manner. This chart is made after a study was done in 1990s called Determinants of Portfolio Performance. In this study, the researcher, they found out that more than 91.5% of the returns in a portfolio actually comes from asset allocation, as you can see here. How much important is finding the right security stock, or how much important is finding the right mutual fund, for that matter. You can see in a portfolio, a security change in security selection can impact the returns by around 4.5%, whereas market timing can impact the returns by around 2%. And the other factors that we look at in the market, GDP growth, rupee depreciation, and there are so many stories going on a day-to-day basis. All those things put together impact somewhere around 2% in a portfolio over a long period of time. Now, clearly, if you want your portfolio to do well, if you want your portfolio, if you want to focus on the returns of your portfolio, then you should focus on the 91.5%, which is asset allocation, and not on 4.5% or 2% or 2.1%. What happens usually, we are more focused which mutual fund to go for, which AMC to go for, which stock to buy. We are more focused towards that rather than focusing on our asset allocation, which is the biggest determiner of how our portfolio will do over a period of time. So, to give you again a very basic example, in the recovery rally of 2020, or before the correction of 2020, let us understand, if I was heavily invested into equity before 2020 and 2020 happened, no matter which mutual fund I was invested into or which stock I was invested into, there was a correction and I lost money in 2020 correction. Whereas during the recovery rally, again, no matter which equity mutual fund or stock that I took, I made money in the recovery rally. So if I had picked the right asset class at that time, I would have either prevented the losses or made money. This is the importance of asset allocation. So of course, we won't know the exact timing when to completely enter the equity or exit the equity and things like that. We understand that timing is not possible. But if we divide the asset class, then it will help us prevent a lot of losses and get a lot of gains in a long period of time. So this is the crux of the entire presentation. Because let me tell you how we expect the returns to be made. We as an investor, we feel that say equity has generated 12% returns in the past 10 years. So next 5 year my returns will be 12%, 12%, 12%, 12%, and 12%. This is a typical investor's expectation, that every year they'll get somewhere around 12%. This is how they expect the returns to be in a linear manner in equity. Does this happen? This does not happen. In reality, first year could be an average year, second year there could be a correction, Third year could be a mega returns year, 48% return. Fourth year again there could be a correction. Fifth year again there could be a superb return. Overall, what we are expecting to generate 12% returns in 5 year period is possible, that we generate 12% returns in 5 year period. However, the growth may not be linear. The returns may not be linear. There could be a lot of ups and downs. And are we ready for that reality? Now look at the returns over here. Say you invested 1000 rupees. First year, average return 8%, it goes to 1080 rupees. Second year, there is a correction in the market by 14%, that 1080 becomes 929. What was your principal? You invested 1000 rupees. Current value is 929. That means after staying invested for 2 years, your value is even lower than principal. This is what triggers most of the investors to get out of equity, because their value has gone below the below the principal amount, or their value has gone below what fixed income is offering. This is where many investor will take the jump that let's get out of equity and let's move into fixed income. But what they are missing out is third year mega returns is possible in equity after a year of correction. And again, you can see in fifth year there could be a bigger, very big return that is possible. So instead, if after 2 years at 929 rupees, if I exit the equity market, then my returns will look something like this. Say third year I go into a fixed income instrument where I'm getting some fixed kind of return, say 7%. I'm earning 7% year on year. It's linear. There are no ups and downs anymore. However, at the end of 5 years, the value that I invested 1000 has grown only to 1138, which is only 3% compounded return in a period of 5 years. What you could have made is 12%, but what you actually made is 3%. This gap, this gap is known as behavior gap. This is not because equity market did not make returns. This is actually because we do not have the experience in the equity market. Our expectation was to get linear returns on a year on year basis for the next 5 years. It is because of instant gratification we could not have patience to wait for a 5 year period. We got out in the second year itself. And that is the reason why many investors are unable to get superb returns in their personal portfolio in spite of market doing so well in the last 15, 20, 30 years in India. If suppose I invest 50% into equity and 50% into debt, then you can see how the extremes change. For example, in 2011, a 100% equity portfolio gave minus 24% returns. But if I did 50-50, then instead of falling minus 24, it corrected by only 3%. This is the difference that asset allocation can make. So you corrected 21% less. That means you will have to gain that much returns less while recovering the value. As a result, your returns over a period of time can be much more impressive. It works on both the ways. If my losses are prevented, even if I am gaining a lot in equity, say for example, in 2017, equity return is around 28%, but 50% equity, 50% debt return is close to 16%, which is not bad. It's just that it is not as high as getting what 100% equity would have got. So if I keep comparing myself with very good equity years, then I might not feel that asset allocation is the right thing. But everyone of us has to remember that all of this data we are looking is in hindsight. It has already happened. We already know about this. So now we can do a lot of judgment and analysis. But today, at this given point in time, do we know what is going to happen next year, next day, next month, anything like that? We don't know. And that is why asset allocation makes a lot of sense today. In hindsight, maybe we'll feel that I could have easily moved to equity and then moved to debt and jump around here and there and made a lot of money. But it can only work in hindsight when we are doing academic studies. In a practical approach, asset allocation is much better, much more practical, and it can help every one of you. Now, another thing, another time for another story. This is actually a case study which happened. This case study is of Harvard Business, and they found out that if suppose you have no goals, you have not decided upon any objective, then you made an X amount of money. For example, let's take 1 crore rupees. Without any goals, without thinking about objectives, you just invested and you made 1 crore rupees. If suppose you had a goal, you had an objective, you were fixated, then you made 10 times more money. You were 10 times more successful than a person with no goals. In this case, let's take, since we have taken 1 crore example, then a person with goals was 10 times more successful, so they made somewhere around 10 crore rupees. There were only 3% people who had goals and they had written their goals, and these people were 30 times more successful. So 30 times of 1 crore is approximately 30 crore rupees. Now, what we are trying to understand here is we go blindly in the investment journey without having any goals in our head, without writing down anything. Just every day we are trying to catch something, trying to earn something without having any goal in mind, without having any end journey, how we are going to spend it, where we are going to spend it, and when we are going to spend it. As a result, we don't have the motivation to stay invested for a long period of time. We don't have a motivation that why, when the markets are correcting, why should I stay invested and wait this period? And because of this lack of motivation, because we have not decided on our goals, we end up not making great returns. We end up exiting at the wrong time rather than waiting out the turbulent times or volatility that we see in the market. And this is another learning for today for the people who are listening, that please decide on certain goals that you want to achieve in your investment journey. These goals, I feel at least there should be 4 goals in each and everyone's life. But make sure that you define these goals very well. Like, for example, uh, if you want to buy a house, the goal shouldn't be that I want to buy a house. It should be you want to buy a house of what value. You should also mention that what is the amount that it will take to buy that particular house, in which area you want to buy a house, what should be the square foot carpet of that particular house. You have to be more specific when defining your goal. Then the chances of achieving that goal increases multifold. The chances of you being successful in achieving that goal increases multifold. And asset allocation will definitely help you to achieve your particular goal, but try to decide on at least 4 such goals where you can work on, which will help you to stay motivated when the equity markets or when your investments are not doing well. So equity markets have always been volatile. It is not that in the just last 6 months it has been volatile. It has always been volatile, and that is the reason why we do not have so many people participating over here. People participating in equity market have increased just recently because of bull market, but in the last 6 months again we are seeing a drop. So how to navigate this? There are a lot of ups and downs. How to navigate this? One way of navigating it is asset allocation, which can act like a bridge between these ups and downs. It can act like a ropeway. So if you have to climb this mountain, you have to go up, you have to go down, again go up, again go down. It is very hectic. It is very time consuming. It can drain your energy. But if you have a bridge in between mountains, if you have a ropeway in between mountains, it can make your journey much, much easier, and the experience of that particular journey much better. That is what we want to give you with asset allocation. So, over a long period of time, there will be minor changes, which at that time will not feel much. You'll feel that, okay, I got only 8% returns. Okay, I got only 12% returns. But a consistent returns over a period of 5 year, 10 year, 15, 20 year, you will see that compounding happen. You will see that how your returns increase and how wealth creation happens. But for that, there has to be some improvement every day. This comes from a Japanese concept called as kaizen, where rather than focusing a lot on innovating, they focus on improving. What they feel is that I should be better than what I was yesterday. If I improve a little bit, then the efficiency will increase, and automatically over a period of days, there will be a very big impact. So in investment, what we suggest is just stick around. Today, it might not feel that there was a very big return that I made, but over a period of time, the return will compound and it will feel massive after some time. So thank you very much for listening to this particular webinar. I would like to also add that mutual funds are subject to market risk. So please read all offer documents carefully before investing. So I am not saying that mutual funds is without risk. There is definitely risk in each and every product. You should be aware about that risk before you invest. That is the only thing that we want to know. We want to tell every one of you. So rather you go for asset allocation product, you go for pure equity product, you go for fixed income, gold, anything in mutual fund. Know about it before investing. Just don't look at past returns. Don't be greedy while investing. Be focused. So if there are any questions on today's session, then I'll be more than happy to take it. You can put it on the comments box, and we can take a few questions for the next few minutes.
This, this webinar was truly insightful. I'm sure we've all learned something about the art of asset allocation and mutual funds and how it can be beneficial. Before we conclude, I'd like to open the floor for any questions from our audiences to be addressed.
So Angelica, if you find any question in the comments, just let me know. We can
Yes, or
discuss it.
any if you want to be addressed, sir, any comments that you'd like to address from the comments, you can just let me know and we can just pick them up because I want to
There
stay
are a
from
few questions which are directly for SBI Securities,
it.
so I'm sure
Correct.
someone from SBI Securities can get in touch with
Go ahead
them.
and answer. Yes, correct.
Then, for direct mutual fund, I would just like to say that there are options to invest in direct mutual funds, but I would like to also add that if you feel that you are expert enough to pick a mutual fund, because there are more than 1500 options at any given point in equity, debt, and all these areas. So if you feel that you know about it, you are an expert in this area, only then go for a direct mutual fund. Otherwise, it is recommended to take help of an expert, like we do in all other aspects of life. For example, if I want to make a table made, I don't go buying wood and start making it myself, because I know I won't do a great job at it. I'm not an expert of making a table, but I'm sure that if I give it to a carpenter, that person can do a very much better job than me. So in this case also, if you feel that you can do a very good job picking the mutual fund as per your objective, as per the market, as per your risk appetite by yourself, then by all means go ahead. Otherwise, it is more recommended that go with an expert who can help you in a long period of time. So
Now we
there's
have a
another question.
question from yes from Sumit Jana, and
Yes.
is asset allocation so does asset allocation comprise of Indian and international equities plus debt plus gold or silver?
So I can say, Sumit, that yes, asset allocation comprises of Indian equity, global equity, fixed income. It can also have REITs. It can have commodities like gold, silver. In certain cases, some other commodities as well. There are two types of asset allocation that you can see. One asset allocation is of your mutual fund portfolio. One asset allocation will be of your net worth. When we are looking at net worth, over there your real estate investment will also come into picture. You must have bought a house or land or anything like that. Even that will be that can be considered. Your fixed deposit investments can be considered, provident fund, ppf, all those things will be considered. So you can make this chart by yourself, or you can ask someone for help, some expert who can help you in understanding your asset allocation, because many of us do not know that how much percentage of our net worth is invested in which asset class. So either you do this as a homework or ask someone to help you to do this. And once you are aware, then you can make some changes. If you are too much heavy on one asset class, for example, most of the Indians are very heavy on real estate. They don't realize this much, but most of their net worth is locked into real estate. So if you find some things like that, then maybe you can do some changes going forward. So a very good question indeed.
Is there any other comments, sir, that you would like to address?
I think there is a question by Mr. Prabhas Dwivedi, who is asking what
Yes.
is ideal asset
What is
allocation
the
for
idea?
highest growth. Now, Prabhasji, I would like to say that if we are saying growth and if we are meaning that only returns, 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 then of course investing into aggressive asset classes will help us. But I have just shown the different slides which are explaining that if we are just behind going behind returns and not looking at the investor experience or what it does to us, then we might end up missing out on returns, the very thing that we are pursuing. So it is a very personal question, because people with high risk appetite might end up investing more into aggressive asset classes like equity, real estate, and people with a little conservative mindset might end up investing higher into a fixed income kind of a category. So ultimately the answer will depend on person to person. But in a general parlance, this is my suggestion, that if you want growth on the higher side, returns on the higher side, you can allocate more than 50% into equity and then rest into other asset classes. But again, please take advice with someone who knows more about this, who knows you and your goals personally before going for it. Suresh ji has asked very interesting questions. He is asking, is large cap better option to invest now? And although this is a market related question, not completely towards the asset allocation, but I would like to say that yes, large cap indeed looks much better in most of the market scenarios, since these are the biggest companies of the country, more stable. And today, after having a very average kind of performance in the last 2 to 3 years, large cap valuations also look better. So yes, you can go ahead with large cap investments, but please don't leave your asset allocation, and consult someone, some advisor, some a person whom you trust, who knows about this, before making the final call. Kalyani Sahuji is asking, only growth option is available. That's why my question. Okay. So growth option is available in direct mutual fund and regular mutual fund, both the places. And apart from growth, there is another option called as IDCW. Growth is an option under direct and regular both. Growth simply means that whatever investment returns are being generated, it is in getting invested in the same mutual fund. You are not getting any payout out of it. That means growth. So continuously the NAV keeps on increasing. Whatever returns we get gets on reinvested. That's the only meaning of growth. There is it is not different from direct or regular. Direct and regular are something which is different. There is a question from Mr. Hari, who is asking to contact an expert to achieve his goals. And I think you can get in touch with someone from SBI Capital Securities for that at the moment, since they have been kind enough to host this webinar. So please get in touch with them, and I'm sure they will help you out with that. Sonu ji is asking, I'm 40-year-old, my monthly income is 77,000. I think the question is missing. But again, Sonu ji, I think please do not enter your personal details over here. This public platform. Please consult someone whom you trust, who knows about this, and discuss it with them. I'm sure they'll be helping you out with proper asset allocation.
Thank you, sir, for your insights on asset allocation and mutual funds. We surely found this session knowledgeable, and I hope the audience liked it as much as we did here. Your expertise and passion for this subject were evident throughout your talk, and we appreciate you taking the time to share your valuable insights with our audience. Thank you very much.
Thanks a lot, Angelica and SBI Cap, for this. And I again would like to reiterate, please don't invest on greed and on returns. Please don't invest only on past returns. There is no guarantee that past returns will happen in future. Be aware of the market, and always, always, always take someone's help if you feel that you don't know completely about this particular investment product. I am sure that there are many videos and reels that you will be watching, which will be giving you confidence that it is doable. Anyone and everyone can do. It's very simple. But the fact remains that there are many things that you need to consider, which you might miss out just looking at certain videos. Even for that matter, just listening to me doesn't mean that you know everything about asset allocation right now. It was just a webinar to create awareness. Please contact someone who knows about this, read about it, and then take the final decision. Thanks a lot, everyone, and have a great day. Invest correctly.